The IRS updated 7 rules this year. None of them were announced in a press release. None of them were covered by any major news outlet. And if you are over 50 and still filing the same way you filed 3 years ago, at least 2 of these changes are already costing you money. This is not about tax loopholes. This is not about hiding income or aggressive deductions. This is about the IRS quietly adjusting the rules that determine what you owe, what you are protected from, and what penalties apply to you automatically. Most people over 50 are operating on information that was correct when they learned it and is no longer correct today. By the end of this video, you will know all 7 changes, which 2 hit hardest if you are within 15 years of retirement, and the one that your financial advisor is almost certainly not telling you about because it requires them to redo a calculation they already submitted. The first rule is the required minimum distribution table. If you have a traditional IRA or a 401k, the IRS requires you to begin taking distributions at age 73. The amount you must take is calculated using the IRS Uniform Lifetime Table. In 2022, the IRS updated that table to reflect longer life expectancies. What that means in practice is that the required withdrawal in any given year is now smaller than it was before 2022. If your financial institution is still calculating your RMD using the old table, you are withdrawing more than you are legally required to. You are accelerating your own tax liability by years, and you are doing it because nobody updated the spreadsheet the brokerage uses to send your annual RMD notice. The IRS has acknowledged this is a widespread issue. On a $500,000 IRA, the difference in year 1 can be over $4,000 in unnecessary taxable income. Go to the IRS website, search Uniform Lifetime Table, and compare what your brokerage sent you against what the current table requires. The second rule is the Social Security Combined Income Threshold. The point at which your Social Security benefits become taxable has not been adjusted for inflation since 1983. It was set at $25,000 for single filers and $32,000 for married couples. It has not moved in 43 years. Everything else has tripled in cost. What this means is that more Americans are crossing that threshold every single year purely because of inflation, not because they earned more in any real sense. Up to 85% of your Social Security benefit can be subject to federal income tax once you cross the combined income threshold. The IRS updated reporting guidance in 2026 that affects how this is calculated when you have qualified charitable distributions from your IRA. If you are making charitable contributions out of your IRA and also collecting Social Security, the order those distributions are processed on your return affects whether you cross the threshold or not. Most preparers file them in the default order. That default is not always the best order. A single line change on your return can keep you below the threshold. The third rule is the Medicare IRMA brackets. IRMA stands for Income-Related Monthly Adjustment Amount. It is a surcharge the federal government adds to your Medicare Part B and Part D premiums when your modified adjusted gross income crosses certain thresholds. In 2026, those thresholds were adjusted slightly upward, but what did not change is the 2-year look-back rule. Medicare uses your tax return from 2 years ago to determine your current year IRMA surcharge. That means your 2026 Medicare premium is based on your 2024 income. If you had a one-time event in 2024, a home sale, a large Roth conversion, a business distribution, you may be paying a surcharge this year based on income you will never see again. The IRS and Social Security Administration have an appeal process called a life-changing event reduction that can eliminate the surcharge when the income spike was non-recurring. Most people paying elevated Medicare premiums right now do not know this appeal exists. You have to file it directly with Social Security. The window is open. The fourth rule is the catch-up contribution limit for people between 60 and 63. Secure 2.0 created a new super catch-up contribution window for people who are specifically between 60 and 63 years old. In 2025 and 2026, that super catch-up for 401k plans is $11,250 instead of the standard $7,700 catch-up limit. If you turn 60 in 2025 or will turn 63 before December 31st, 2026, you are in the window right now. Most HR departments have not updated their contribution election systems to reflect this. The default catch-up contribution your payroll system shows you is still the lower number. You have to call your plan administrator directly and request the higher limit in writing, not HR. The plan administrator. Get it confirmed in writing before October, or you lose months of contributions you cannot get back. The fifth rule is the estate tax exemption sunset. The current federal estate tax exemption is $13,600,000 per person. That number is scheduled to be cut roughly in half at the end of this year unless Congress acts. As of today, Congress has not passed a permanent fix. If the exemption sunsets back to the pre-2017 baseline, the threshold drops to approximately $7 million per person. Most people hear 13 million and immediately think this does not apply to them. But the combined estate calculation is broader than most families realize. It includes the full market value of your primary residence, every retirement account, every brokerage account, any business ownership stake, life insurance death benefits paid to your estate, and any real estate you own, including rental property. A couple in their 60s who bought a house in California in 1998 has 2 funded 401k accounts and owns a small rental property can be sitting on a combined estate of $4 to $6 million without ever thinking of themselves as wealthy. After the sunset, a $7 million single-person threshold means that surviving spouse could be exposed. If you and your spouse have a combined estate approaching that number, you need to be executing estate planning strategies before the sunset, not after. The tools that protect you: spousal lifetime access trusts, irrevocable life insurance trusts, strategic gifting, cannot be created retroactively. An estate that is protected under the current exemption can become a 40% tax liability in January if the sunset happens and you did nothing. The sixth rule is the inherited Roth IRA distribution requirement. Before the Secure Act, a non-spouse who inherited a Roth IRA could stretch distributions over their lifetime. Now they must empty the account within 10 years. For the first few years after the law passed, there was genuine ambiguity about whether annual distributions were required within that 10-year window, or whether the beneficiary could simply wait and take everything in year 10. The IRS finalized guidance in 2024, making clear that if the original account owner had already reached their required beginning date, annual distributions within the 10-year window are required. Beneficiaries who inherited accounts in 2020 or 2021 and have been taking nothing may already be 3 or 4 years behind on required distributions and may owe penalties they have never calculated. If you inherited a Roth IRA in the last 5 years and have not been taking annual distributions, you need to speak with a CPA this week. Not this spring, this week. The seventh rule is the penalty rate for excess IRA contributions. If you contribute more to an IRA than you are allowed in a given year and do not correct it, the IRS charges an excise tax on the excess amount every year the excess remains in the account. That penalty rate increased from 6% to 10% for tax years beginning in 2024 under Secure 2.0. If you or your advisor made an excess contribution in 2023 or 2024 and has not corrected it, the penalty is now 10% per year, compounding on the uncorrected balance. This catches people in 2 specific situations. First, high earners who contributed to a Roth IRA in a year when their income pushed them above the eligibility threshold. The Roth IRA income phase out for single filers in 2026 begins at $150,000. Many people contribute early in the year before they know what their final income will be and find out at tax time they were ineligible. Second, people who contributed to both a traditional and a Roth IRA in the same year without knowing the combined annual limit applies to both accounts together, not to each account separately. The combined limit in 2026 is $7,000 if you are under 50 and $8,000 if you are 50 or older. The correction process is straightforward if you act before October 15th. After that date, it becomes a compounding penalty that the IRS will collect on every year you leave the excess untouched. The action from this video is 3 things. First, pull your 2024 tax return and find the RMD distribution amount your brokerage reported. Compare it against the current IRS Uniform Lifetime Table using your age and your December 31st, 2023 account balance. If the number your brokerage sent you is higher than what the table requires, you withdrew more than you had to and you paid taxes on the difference unnecessarily. Update your instruction to your brokerage for 2026 before the end of this quarter. Second, if you are between 60 and 63 years old and you have a 401k, call your plan administrator today and ask in writing whether your plan has adopted the Secure 2.0 Super Catch-Up Contribution Limit of $11,250. Do not email HR. Call the plan administrator. If they say yes, file the updated election immediately. If they say they have not adopted it yet, Ask when they plan to and get that answer in writing. Third, if you inherited any IRA or Roth IRA since 2020 and have not been taking consistent annual distributions, contact a CPA before June 30th. The IRS has begun issuing penalty notices for accounts where the beneficiary is behind on distributions under the 10-year rule. The penalty is 50% of the amount you were supposed to take and did not. The IRS does not send letters when the rules change in your favor. It sends letters when you owe more. Everything else is your responsibility to find.